we will try to finish by 6 p.m. Each session will be shorter compared to the morning session. Well, the first two sessions will be shorter. I will introduce two papers. One is from a collection of authors from the ECB. It's entitled The Road to Paris, Stress Testing the Transition Towards a Net Zero Economy. Chiara Lelli will present, and this is a very comprehensive empirical paper on that takes a macro-prudential perspective and makes a use of a huge amount of data. The second paper is by colleagues from the Bank of Italy. Alessandra, Iannamorelli will present. The paper is entitled The Dual Phase of Carbon Emissions, Transition Risk-Adjusted Probability of Default. This is, again, an empirical paper. This is much more surgical. It takes a macroeconomic approach. We have at the bank, we have this interest in the credit risk assessment of firms, and this paper is about the probability of default of individual firms. So without further ado, I will ask Chiara Lelli to present their paper. Thank you.
So thank you. Thank you for selecting the paper. It's an honor to be here. I'm gonna present you the second climate stress test that we conducted in the Financial Stability Department of the ECB. And just a disclaimer, the views that we present and that are in the paper are just the ones of the authors and not of the institution. So in the presentation today, we're gonna go through a short overview of the exercise. We're gonna see the scenarios that we developed, the model that we use, and the result that we got, and then we're gonna wrap up with the conclusions. So the first ECB top-down economy-wide climate stress test was a cost-benefit analysis. There we used climate scenarios that are in the long term, so 30 years time horizon, that considered both transition and physical risk. We used very granular information for on climate and financial risk of firms for millions of corporates to which euro area banks are exposed via loans and securities. And we developed new models to be able to capture the climate risk transmission channels, first to firms and then to banks. The main results of that exercise were that the short-term costs of the transition were more than compensated by the long-term benefits, and that there could be potentially severe impacts to the most exposed firms and banks. So we know that we have to transition, but the question now is how? And to try to reply to this question, we conducted an impact assessment of different net zero transitions. And to do so, we developed scenarios that are short-term scenarios that focus on the transition risk and on the energy development over an 8-year horizon until 2030. This exercise was conducted in with the cutoff date of end 2022. The scenarios were developed combining BNP projections with NGFS scenarios and updated starting points in order to be able to reflect the macroeconomic and energy context at the end of 2022. We announced also our models. we moved from emission-based models to energy-based models that included also new transmission channels. For example, standard assets and green investments. We also included amplification mechanisms in the form of downstream and upstream GVA shocks. And we also added new modules, one on households and one on non-banks. Now, looking at the scenarios, we developed three short-term scenarios that differ among each other, depending on the ambition and the timeliness of the transition. So the first scenario is what we call the accelerated transition. And the idea here is that the energy crisis in 2022 triggered a sudden and strong transition to the greener economy that start immediately. So in 2023. The emission reductions that are implied by this scenario are compatible with a net zero by 2050 scenario of the NGFS. The second scenario is the late push transition. Here, in this case, the transition doesn't start immediately, but in 3 years' time to let the economy recover from the adverse macroeconomic developments. However, the transition in this scenario is strong enough to lead to emission reductions that are compatible or similar to the ones of the first scenario. The third scenario is what we call the delayed transition. And also in this case, the transition starts in 3 years' time, and it is orderly, but too weak to reach a similar emission reductions as the other two scenarios. Here, I want to show the developments of two main variables. On the left-hand side, you can see the emission reductions that are implied by the three scenarios. And we can see that in 2030, only the first two scenarios are compatible with an increase in temperature of a maximum of 1.5 degrees by the end of the century. And they lead to an emission reduction by 2030 that is around 68%. This doesn't happen for the third scenario, which is less ambitious. Looking at the right-hand side, we can see the developments of the energy prices, in particular electricity and gas prices. And here we can see two features. One is the updated starting points, and it is visible in the jump from 2021 level to 2022. And then the second feature is the impact of the transition. And specifically in the electricity prices, we can see that as soon as the transition starts, the prices grow. And then they tend to decrease later on in the period. What we consider as the transition focus for the transition efforts from firms are of two different kinds. First of all, for one main assumption is that the electricity sector is the one driving the transition. And so the electricity sector will invest in greening their production so that the rest of the economy has only to focus on electrifying their processes and rely on greener electricity. This development is very visible in the evolution of the energy mix over time and across scenario. And we report here the euro area aggregate of the energy mix. And we can see that in the first two scenarios, in 2030, the electricity accounts for around 42% of the energy mix, and it is made from around 70% of renewables. Whereas in the third scenario, the electricity accounts for only 28% in 2030, and it is made from only 54% from renewables. So looking at the data, looking at the models, if we consider first the corporate model, this is a very granular model. We have around 2.9 million firms, and the three key variables that we saw in the previous slides enter in the model through three main transmission channels. These are the energy expenses, the green investments, and the energy demand. They have an impact on the balance sheet of firms, so they tend to increase the operating expenses, the financial expenses, and they increase or decrease the revenues depending on the sector the firm is operating in. Overall, there is a decrease in the profitability of firms and an increase in the leverage, which has an impact on the PDs of the firms, with spillover effects on banks and non-banks. In particular, the PD of the bank's corporate loan portfolio increases, and it also generates expected losses for the corporate loan portfolios and the security portfolios. Looking at the households, in this case, we work at the country level because of the lack of very granular information for households. And again, here, the three main variables, so the energy price shock, the energy mix, and the emission pathways enter through the energy expenses and the green investment, and tend to increase the debt and decrease the income of household, having an effect on the credit quality of the residential mortgages, which generates expected losses for banks. One important novelty of this work is the modeling of the green investment. As mentioned before, we have two kinds of investments. From, let's say, all the sectors are expected to invest into carbon mitigation activities, such as carbon sequestration and improving the energy efficiency of buildings and so on. And we estimate these, we model this based on IPCC estimates. The second kind of investment is the one made mainly by the electricity sector, and in this case, the electricity sector is expected to invest into renewable energy capacity. So in order to green the production of electricity. Here we focus mainly on the solar and wind energy system, which account for around 87% of the production of the renewables that are used. And the model is based on the idea of the experience curves. So the more you invest into renewable energy capacity, the lower the costs of investment become over time. Overall, the green investments account for range around between 2.5 and 3.2 trillion euros over the 8 years, with the highest levels in S2, and so in the second scenario. And here, the assumption is that firms are expected to take up new loans to cover these investments. So that is why there is an increase in the indebtedness. So there is an impact on leverage and profitability. And here in the chart, we can see that the biggest bulk of the investments come from the second kind of investment, so the one on renewable energy capacity. So looking at the results, starting from the corporates, we can see that if we look at the left-hand side charts, the credit risk increases during the transition, and it peaks in the late push scenario. At the end of the period, the accelerated and the delayed transition lead to similar risk levels. However, in the first scenario, we are in line with the net zero by 2050 NGFS scenario, which is the optimal one. And the PDs already start decreasing around 2027, whereas in the third scenario, so in the delayed transition, PDs keep increasing. Another important result is the heterogeneity across sector. So we see that the mining and the most energy intensive sectors are the most impacted ones. Similar results can be found in the households, and here we defined in different measure, that is the credit quality deterioration, because we cannot define a PD considering that we are working at country level, and it is defined as the share of new defaulted exposures over the total exposures. And again, as said before, the results are very in line with the corporate. So increasing credit risk during the transition, and peaks in the late push transition. Putting everything together and matching it with the loan portfolio books, we can see that in the results for Banca in 2030, the annual expected losses for the medium bank in the S1 and S3 are 48% higher compared to 2022 levels, and 78% higher in S2 compared to 2022 levels. And in this means that banks will have to increase their provisions by at least as such. And another important aspect that we see is the fact that we are able to disentangle the impact of the macroeconomic developments from the impact of the transition. And we see that a 25% increase in annual expected losses from 2022 to 2030 is driven by macroeconomic development and the current climate policies. And the remaining one is attributed to the additional transition efforts. Very quickly on the market risk, for banks and non-banks, for banks we see that the absolute losses from market risk are limited, but the relative losses relative to the portfolio fair value are significant, especially in the tails. And for non-banks, the market risk impact is substantial, and it is similar across sector, but with different magnitude, and this is due to the different portfolio allocation. And to wrap up, so this in this exercise, we developed new short-term transition scenarios. We have a granular modeling of energy-related developments and also sector-level dynamics, and we have an unprecedented coverage of entities and exposures. And conducting this exercise, we find two main messages. That one is that the credit risk increases significantly during the transition, having heterogeneous impacts across sectors, and it is the highest in the late push scenario. And that the second message is that the accelerated and the delayed transition lead to similar risk levels in 2030, but with main differences. So in the first case, the PDs, so the risk tend to already start decreasing before the end of the period, whereas the trend is positive in the delayed transition, and that only in the first two scenarios we see the emission reductions by 2030 are compatible with the net zero by 2050 optimal path. This means that the financial risk could become much higher after 2030 in the delayed transition, because we will need to take into account also the physical risk effects. And with this, I conclude. Thank you.
Okay. Let's move on to Alessandra's paper.
So, good afternoon. Thank you, Antonio. So we will now talk about the dual phase of carbon emissions, transition risk adjusted probability of default, a working paper prepared together with the two colleagues of mine, Federica Vassalli and Manuel Cugliari. Let's quickly dive into the outline, which is a very standard one. We have a quick look at the background, research question, preview key results, data methodology, final result and conclusion. Let's start with the background. So we know that the ECB and the whole Eurosystem are committed to improve methodology, to enhance methodology and conduct analysis to monitor the implication of climate change and its related policies for the economy. In particular, the ECB published in 2022 the so-called common minimum standard to incorporate climate-related risk into the in-house credit assessment systems developed within the Eurosystem. The methodological and the climate debate behind our study involves, from the one side, the emissions, because we know that the emissions can be controlled via price-based mechanism like cap and trade, like carbon taxes, or via cap and trade systems like the EU ETS. Then we also know that measuring emission can follow either a top-down approach or a bottom-up approach. From the other side, we know that incorporating climate-related transition risk into the credit risk assessment usually involves carbon tax along with the long-term NGFS scenarios. And usually it covers listed firms, sometimes using EU ETS data. As a cap and trade system, the EU ETS market sets a cap to the GHG emissions produced by participating firms' installations. Without such limit, participating firms can buy or sell allowances or quotas according to their needs. Some allowances are available for free of charge, but firms not provided with free allowances or quotas or exceeding their free allocation must buy allowances at auction or from other firms. The EU ETS carbon price can be measured by daily spot or future market price of European emission allowance, which is the trading currency. These markets, in particular the future markets, are highly liquid, and the price evolution follows is affected by policy decision, fundamentally. So we see in this graph, in particular, that these decisions sometimes generate clusters in volatility, which recall first of all stochastic model, and then a model able to capture this volatility cluster. We will use this idea later on in the presentation. Our research question asks, what is the effect of carbon pricing on non-financial firm creditworthiness? So we know that precisely quantifying emission is essential for embedding transition risk into the credit risk assessment. We also know, because of the before mentioned common minimum standards, that the ECB recommends the inclusion of emission and carbon price at a firm level data. Namely, especially if possible, exploiting the UETS. So the emission production can affect firm creditworthiness either positively or negatively. So an excess of emission production over quotas increases costs, while an emission shortage can eat revenues. So we use UETS market-based stochastic simulations of carbon price trajectories, and we use conditional value at risk to select extreme scenarios. We also project the short carbon price onto financial statement to get firm, fundamentally based stress PDs. So in our study, we employ a unique granular dataset on verified emission from the UETS to estimate the effect on carbon price-related transition risk into the one-year probability of default of Italian non-financial firms. Thus, in this way, we try to solve the existing mismatch between the long time frame of NGS scenarios and the short time frame of the short horizon of the credit risk assessment. In particular, we manage, our methodology applies both to listed and unlisted firms, because we rely on balance sheet data, and so we study the effect of balance sheets rather than relying on the market risk premium, like the carbon premium. Further, stochastically simulated price trajectory are easily aligned to the one-year horizon of credit risk, as I was mentioning before, with respect to the longer time frame of the NGF scenarios. So what we find? We find that the UETS market provides, as expected, a direct insight into individual firms' emissions, allowing for a more accurate bottom-up transition risk assessment than the standard top-down approach. Our results show that PDs estimated via scenario analysis based on the UETS are more sensitive to transition risks with respect to the PDs estimated via NGFS trajectories. And more importantly, we find that for a few firms, we observe a rating upgrade. The data we use are collected from three main data sources, two of them for the UETS. In particular, for the UETS, we collect firm level data regarding emission, allocation of allowances and transaction from this electronic registry of carbon parameter transaction, which is the European Union transaction log. Here in this picture, you find the structure of this registry involving several stakeholders, like corporate entities, their intermediaries, or regulatory bodies and market operators. Another data source relates to market data, and namely historical price and volumes for spot and futures allowances price. And these are sourced from Bloomberg. And the third and last data sources is the Bank of Italy ICAS, where we collect financial statement data from, for Italian firms, of course, from CEBI and CERVED, and also credit behavior data from the National Credit Register, which is this comprehensive archive managed by Banca d'Italia. The integration of BICAS financial and credit data from the one side with the emission transaction records from the UETS from the other side generates a unique data set. So by using specialized algorithms combining different matching techniques, we managed to reconstruct data, UETS data on emission and transaction for 572 firms, covering the 28% of Italian total emission in 2022, as displayed in the table. Methodology. I will try to resume the methodology in 3 main steps. First step, we model the price trajectory for future contracts on the UA certificate via price volatility through an asymmetric parametric model. According to literature, we used GJR GARCH, allowing for leverage effect, meaning negative correlation between returns and volatility. This is the general specification of the GJR model. What it is important here is the equation number 3, where we find the characterizing term for the GJR, allowing for leverage, which is the central term on the right-hand side, where we find this function I, allowing for leverage effect because it assigns the coefficient gamma to below average returns. By using this specification, we are able to forecast conditional volatility for T plus H periods ahead via Monte Carlo simulation, where H is 1 year. So based to this equation, we get 1 year ahead trajectories for a UA certificate future price. Second step involves measuring the extra production cost the firms bear for their emissions. Here, according to literature, we get the extra cost as a product of extra EUA certificate, the quantity from the one side, times the price increase, which is this difference between the estimated price via GARCH, the P hat, and the average of the price in the past 12 months. This extra cost can be either positive or negative according to firms' surrendering quotas. In order to project the extra cost into the balance sheet, we need to define 2 scenarios. For the baseline scenario, we take the average Monte Carlo simulated price, and for the extreme scenario, we apply a conditional VAR approach, as mentioned, focusing on the average of the worst 5% outcomes in the extra cost distribution. Third, the final step of methodology is stress testing the financial statement. Here we need to distinguish between 2 possibilities, firms in deficit and firms in surplus. For firms in deficit, we assume that the firm adds the purchasing cost of extra allowances to the firm, to its income statement. Overall, the net effect on the financial statement is negative. For firms in surplus, the firm, we assume that the firm sells the extra allowances, generating non-operating revenue. And here, the overall effect on the financial statement and that's on the PD is an improvement. Results. First result, in this scatter plot, we find on the x-axis the approximation, the estimated emission through sectoral approximation. On the y-axis, we find the granular measured emission thanks to UETS data. So this is a comparison between top-down and bottom-up approach. So we see that sectoral attribution underestimates emission because most data points lie above the 45% degrees line. This means that thanks to this detailed data and precise data, the UETS market provides a more accurate representation of each firm emission. Result number 2. In the top table, we find a comparison between the rate immigration obtained with our 2 scenarios, the baseline scenario on the top and the extreme scenario on the bottom. We see that the extreme scenario is more cautious because it preserves the ratings for 83% of firms, but it also allows for higher percentage of both downgrades and especially upgrades. These migration dynamics can be better understood in the scatter plot, where we find that the standard PDs estimated by our ICAS on the x-axis versus the transition risk-adjusted PD on the y-axis, with both scenarios, baseline and extreme. So the cyan point represents the baseline scenario, and the red point represents the extreme scenario. In the baseline scenario, PDs are close to the 45-degree line. So meaning slight variation. This means that the firms that are historically capable to absorb carbon costs continue to do so, while in the extreme scenario, we observe larger PD variation, meaning that only the abrupt shifts in carbon pricing affect firm creditworthiness. But more importantly, in both scenarios, points are both above and below the 45-degree line, meaning that we allow for improved PDs due to extra cost. So the UATS methodology is responsive actually to transition risk shocks, first of all, and also to cost and revenue change. So responding via downgrades and upgrades. We now want to compare, for the third result, our approach based on our Garch scenario analysis to the NGFS scenario analysis. To do that, we will add to this scatter plot other two series of PDs estimated via NGFS scenarios. So the first is with an average of NGFS scenarios. The second one with the extreme NGFS scenarios, a little bit more scattered. Then we have our baseline scenario, green points. And finally, the blue point representing our extreme scenario. So we see that even our baseline scenario is more scattered, dispersed around the 45 line than both the NGFS scenario. So this new methodology integrates transition risk more flexibly by adjusting risk classes compared to the carbon tax approach, and also to sectoral data approach. We skip. Okay, so we just go to the conclusion, key takeaways. So our methodology try to improve the non-financial firms' credit risk assessment by incorporating transition risk into the one-year PDs of firms. We focus on implication on carbon pricing on for financial statement with a bottom-up methodology based on UETS transaction in order to quantify precisely the emission of Italian firms, and we are able to cover both listed and unlisted. According to this methodology, firms can either incur extra cost from excess emission or financially benefiting for selling surplus allowances. So this methodology responds to transition risk shocks as reflecting PD variation. And yes, I mean, emission allowances actually enable environmentally responsible firms with this methodology to benefit from transition risk, improving their rating. So we have been trying to address the shortcoming of traditional approaches, and so with this UATS, demonstrating actually that the UATS data allow for a more accurate transition risk assessment compared to top-down sectoral emission estimation, and also compared to NGFS scenarios.
Thank you, Alessandra. Simone Narizzano will give the discussion of the two papers.
Thank you, Antonio. And I'm very happy to have the opportunity to discuss these two interesting papers. Both the authors did a very good job in explaining the methodology and the results. So I'll try not to spend too much time on describing them. but I'll try to focus more on the main contribution of the two works, and I will conclude with some small suggestions for future research or future work. So basically, the first paper presented tried to estimate the effect of different transition scenarios towards firms, households, and financial intermediaries. The authors use a very unique granular data set with the merge of several different data sources. And they use medium-term scenarios focusing mainly on transition risk and energy developments, and try to derive the effect on firms and households using a simplified credit risk model. Their main results, they find that the credit risk increases due to the transition for both firms and households. And the highest risk is reached in the late push scenarios, but with a decreasing trend, while accelerated transition and delayed transition lead to similar risk level by the end of the period, so 2030, but with a decreasing trend in the former case. Obviously, this increasing risk will lead to an increase in expected loss for banks and non-financial intermediaries. It's important to recall that accelerating the transition is crucial, considering that the trend in riskiness would be decreasing, and obviously the implicit level of physical risk would be very much lower with the accelerated transition. Coming back to the second paper, the authors try to assess the impact of carbon pricing towards non-financial firms' creditworthiness. They use a unique data set with firm-level emission data from UETS, merged with financial statement data and credit relationship data. They use a stochastic simulation of a UETS carbon price that is used to determine a firm's probability of default with a full financial statement recalculation in two scenarios, a baseline and the stressed scenarios. So the result, they find that obviously firm-level data allows for a more accurate transition risk analysis compared to sectoral data that often underestimate risks for high-emitting firms. Scenario analysis based on UETS price volatility could be more sensitive than traditional methods based on carbon tax level. And finally, an important result is that their methodology allows for both rating upgrade and downgrade. So that, now I come back to the first paper. I will try to share what are the main contribution of the paper from my point of view. The authors use a very huge combination of different data sources and scenarios, and they combine macroeconomic prediction and climate scenarios very well. Very interesting is the change from an emission-based approach to an energy-based modeling of the transition. So this change allows the author to consider energy mix, consider the country and the sector of the companies. And so they are able to assess the impact of different energy sources pricing evolution. Very important is the sectoral dynamics for the green transition with different effect on revenues and value added. And so we have winners and losers from the transition risk. And then very interesting is the bottom-up modeling of green investment using mitigation costs from IPCC. This is very useful, especially I think for financial statement projection and forecasts. Coming back to the second paper, the authors use a different approach compared to the traditional one based on a different level of carbon tax. So basically they shock the market carbon price. The 12 months temporal horizon is in line with standard credit scoring model. So maybe this could be helpful for an integration in banks' PD model in the future. We saw that sectoral data are often not precise for individual firm assessment. So it's very important to try to reach individual data to assess transition risks. And then an important intuition is that firms could have financial benefits from trading UETS certificates. So again, we have a concept of winner and losers from this transition. Then I will conclude my discussion with some suggestion. So I come back to the first paper. I would try to exploit the UATS dataset, as in the second paper, in order to increase the firm level data and to be more precise, especially for high emitting firm. And then this could allow us to avoid potential double counting, because actually firms participating in this market already pay a price for their carbon emissions. Then I find a little bit too conservative the cost pass-through assumption, because basically there is no pass-through of climate costs to revenues for firms. So I would try to distinguish between short-term price shocks with no pass-through and long-term effect with pass-through to revenues. Maybe a 1 year lag in order to adequate revenues could be a road to follow. I would like to see further elaboration on the firm's PD model, because important risk dimensions are not considered in the model, such as, for example, liquidity ratio or debt sustainability ratio. And then I have a small doubt about the fact that it seems, but maybe I'm wrong, that green investment are not considered among firms' total assets in the calculation of the leverage used in the PD model. And I'm a little bit uncertain about the treatment of Scope 3 as a direct investment of the firms, because Scope 3 reduction should be mainly obtained by investment from a firm supplier. So maybe it could be considered for the amortized part as an operating expense for the firm that I'm analyzing. Coming back to the second paper, I think that considering transition plans with a quantification of green investment to achieve emission reduction targets could be a good evolution of the work. And in this context, I think that you could explore the bottom-up investment, green investment quantification methodology presented in the first paper. Then I would try to use the observed price of UATS effective evolution of price, and then maybe complete the financial year with your stochastic simulation. This mainly for financial statement projection. And maybe you could add also the forecast reduction of free allowances to anticipate the effect on the new balance sheet and on the new financial statement. Then maybe for another work, so you have to work again in the future, you could try to further elaborate on UATS price determinants. So basically, you could change from a volatility market-based approach to a factor model approach. And this factor model approach could be used to investigate the effect of different transition scenarios. And again, the price evolution presented in the first paper could be useful for this new work. And finally, as a general comments, we have seen two very interesting papers. They both treat important topic, climate stress testing and the integration of transition risk in credit risk assessment model. Both papers combine intuition from theory with carefully executed analysis. And so let me conclude with a last consideration. From my point of view, a key policy issue for really obtain the transition is provides funding to brown firms that actually are responsible for the vast majority of the carbon emissions. So I think that in this context, both papers could help to identify the right brown firms to finance through a best-in-class approach. So thank you very much.
Thank you, Simone, for the sharp discussion, and we are open for questions. We have a few minutes. Please, Fabio.
First of all, those two great papers, so thanks for that, and also the discussion. I had a question for Chiara. In particular, I think one issue that's come up post-Russian invasion of Ukraine is that taking longer-term scenario analysis, you essentially forget about the business cycle. More specifically, how central banks or fiscal policy can play a role, particularly if some of these measures are inflationary. So, for example, at the IMF, the way we look at climate risk assessment we look over 3-5 horizon, in part because we want to think about the policy implications. So you can think of a shock that is inflationary. If you model central banking in a model like this, presumably they would react. But because you have such a rich description of the investment process, higher interest rate will interact with the investment process. Similarly, you can think of fiscal policy, right? You can think of like subsidies, for example, to subsidize investment. So I was curious how you think of the monetary policy, fiscal policy interplay here as it plays through the investment, because it seems to play a central role the way you guys look at this, both from the household and corporate, but also from the banking side, obviously.
Thank you. Do we have other questions?
Franco Panfili, Banca d'Italia. I have a suggestion. Before the suggestion, a premise. I think it's important the approach used by Alessandra, because as a risk management point of view, that was my former job. It's important to have the real situation of a company, expected to use average, median, sectoral average, and sectoral median. So I think it's a right road to understand better the probability of default. A suggestion is related exactly was in the same direction of what Simone said before about the use of market volatility. I have the suspect that the ATS market has changed very rapidly, in particular, not only in terms of the amount exchanged, but also in terms of participations. Because now is not a market where there is, I can say, a genuine offer and a genuine demand, but there is also participation of investment funds, in particular, the participation of hedge funds. And I'm sure that it means more volatility. So my suggestion is to move from the market volatility to factor model, for example, to understand the real this presence can distort the market and the quality of the signal of the price of this market. Thank you.
Stefano Battistoni, University of Venice. I have a question. Thank you for the great presentations. First question for Chiara. Could you walk us through again, in the case of the delayed transition, what's the narrative about how the PD evolve of corporates evolve in time in the decade 2025 onwards, and how does that relate also to the volume of investments into around high residual carbon firms? So my question is, what is the story that we learn from the model about whether how high carbon firms do their PPE increase? Yes, no, for how long? What happens in the mid long run? And how much are they attracting more or less investments over time? And then for Alessandra, I have a question. You said that basically the calculation of emissions based on ETS leads to higher estimations of emissions for the firms, and you are assuming that that is a better estimate. I was wondering, how do you know that the other one that you put out, the one based on it, is necessarily an underestimation for the laboratory? Because there could be some other sources of errors, maybe in the way, I don't know, the plans are attributed to the owner, I don't know. So that would be interesting. Thank you.
One last question from Professor Bolton. Thank you.
Thank you. So let me just first say that I think these are two excellent papers that really push the envelope further. So yeah, congratulations. And they seem to me very complementary. The way I see them as complementary is that ultimately you're trying to understand how the transition risk affects default probabilities. And one paper takes the view that transition risk increases probability of default through leverage, because you need more capex, and more capex is financed via debt, and that leads to higher probability of default potentially. And the other paper takes the view that the transition risk is reflected in carbon pricing, and as carbon prices rise and as your exposure to carbon pricing worsens because you don't have the allowances, you're faced with higher transition risk. But in my view, is the two have to go together somehow, and so I just wanted to put that on the table and see, you know, how you would react to that.
Thank you. Now, one word to the presenters. We will start the next session at 3. So your replies will be quick, if possible, because you are standing in the way of our quick break, which will be a type of singing chairs break, just to allow our colleagues to change the names at the table here and resume quickly at 3. So please, Chiara.
Okay, so I'll try to be quick. Just a few reactions to the discussion before. So on the point on considering the scope 3 emissions, well, the assumption is the firm have to decrease all the emissions, both S1 and 2 and S3. And as we saw before, the S3 emissions are the biggest bulk. And so that's the main reason why we also consider them in the green investments, because they can, I mean, firms can actively invest into changing also their processes to reduce the S3 emissions. And regarding inserting the green investment into the total assets, well, we discussed internally a while ago, and our idea is that the amortization of the investment in the long term should not increase the total assets, and we assume that the green investment will be directly amortized through, so basically affecting the profits and not the total asset. That's the main idea, but we can also discuss further. And regarding the fiscal monetary policy interaction with our model, well, in both firm and household model, there are the interest rates and, for example, the inflation are considered. So changes in the monetary policies should have an effect in the firm PDs and household credit quality. I hope that is more or less what you asked for, but and yeah, that is relevant for, of course, for the cycle, business cycle. But regarding the investments, the investments were estimated based on the emission reduction that is implied by each scenario. And basically, firms are expected to take up new loans in the first half, in the first 3 years of the transition, and then the second half of in the remaining part, and they start to repay their debts in 5 years' time for 15 years. Sorry, I finished.
Yes, I will try to be telegraphic. So in order, Franco's questions. Yes, I also agree with the point of factor model. This is a quite historical debate, methodological debate between the simplicity of factor models from the one side, and the opportunity to control all the factor that you put inside from the one side, and from the other side, statistical model, which are more flexible. They cover all the distribution. So in this case, it allows us to adjust the horizon, to adjust where to put the threshold of the distinct scenarios. Very dynamically flexible from the other side. So it's a trade-off, and yeah, in the next paper we will try to cover also this point. Professor Battiston question: how can we be sure that we underestimate emissions when by sector approximation? Because we conduct some statistical tests, and we checked that they move in the same direction than our measured emissions, so that they are consistent each other, and so it is just a matter of difference. It's not a matter of moving in different direction. So this is one, but we will. I'm happy to discuss further with you if you are not convinced of my response. Professor Bolton. So your question is about yes. Probably it's not the question. Is to cooperate, to merge, to find an agreement. And I agree with you. We can do it. Thank you.
Thank you.